I'm Keith McCullough, and welcome back to a real-time conversation. Thanks for joining us. Get to have a conversation that I'd love to have anyway. But you all get to listen in with my friend, economist, and many other things. You got many author, Daniel Lacalle. Thank you for making the time once again to be on Hedgeye TV. I very much appreciate it.
Thank you so much. Thanks for having me. Always a pleasure.
Yeah, and it's good to. We were just chatting before. It's good to see that you're in good health. You're looking like you're working out there, Daniel, and your kids are all good. Everyone's good.
Everyone's good. Thanks. Thank God. So, and to everyone that's watching, stay safe and hope that everything is good as well.
Yeah, for sure. I guess there are three topics I really want to cover with you. There are many other things that we can cover in the Q&A. By the way, if you have questions, pop them in the queue. They'll get voted on, and then we'll ask Daniel those questions. But first, what I want to do is go through the U.S. Economy. Also want to go through one of your deep levels of expertise, which is what's happening in the oil markets and energy markets broadly. And then finally, we'll go through Europe. But first on the USA, I mean, today, I mean, maybe I feel a little bit more sane given what the market's doing today, the equity market being, which is just pretty much what, as you know, what the commodities, bond market, currency markets have been doing all along. But that notwithstanding, a lot of people are focused on stocks and they love chasing their charts. But lo and behold, we have over 30 million now in jobless claims. That's 1 in 5 of able to work Americans. You've lost basically 23 years, Daniel, of the gains in the U.S. labor market. And I wonder, am I crazy? I mean, I don't think there's going to be a V-shaped recovery. So I wonder how you think about the depth of what's happened from an employment perspective, properly from an economist perspective, and how long it might take to work out of that hole that we've just developed. Yeah,
no, absolutely. I think that the jobless claims figures are completely unprecedented, and even the ones that were bearish about the situation of the economy and how it could unravel with the crisis, we've all been quite surprised. We've all been quite surprised with how negative the figure is. About 19% of the labor force is now in some level of unemployment, be it temporary or fully in unemployment. And I think that what that also does is to help us understand how challenging the V-shaped recovery is and how difficult it will be to get the economy back on track. As you know very well, consumption has been a key driver of growth in the last 3 years. And the figure that we saw today of consumption was also staggering in how negative it was relative to an already revised negative expectation. Mm-hmm. So I think that in general, what we can say now is, yes, the U.S. economy will recover jobs more quickly than the Eurozone. Let's remember that the Eurozone right now, most countries have about 30% of their labor force in some form of unemployment scheme. Yes, it will recover quicker than the Eurozone, which is in absolute doldrums, as we will talk about later, I'm sure. But it is getting more and more challenging as time passes to have the optimistic view of a V-shaped recovery that would end with GDP down 1.82%. I think it's going to be weaker than that in 2020. And I also think that the ramifications of unemployment into consumption, into services, and into the general GDP figures and earnings are going to be significant.
Now, can you talk about that and also within the lens of what I would say had to be the most levered U.S. economy in all of U.S. history, maybe human history? I think people just generally didn't quite get that until you saw the deleverage. So again, you get late cycle, we're at full cycle employment, profits start to slow, they go to zero, you keep putting on more and more debt on top of the problem, and then you get whammo. Here you are today. How much of this, we have two big things, and they do sleep together, which is the rate of change of cash flows, or your ability to pay people, and those people having jobs. How important is this moment in time in terms of how complacent or egregious certain corporations got at this stage of the cycle, which was only, by the way, a couple months ago?
Yes, very important because this crisis finds numerous companies and entire sectors completely unprepared for a slowdown, yet alone for a crisis. And the level of leverage was already too high, and the level of complacency was also extreme. I think that also from the perspective of getting back to job creation, one thing that we need to understand is that the US economy already at 2% growth was running at about 75% capacity utilization, which means that there was already some slack. So even if we return to the levels of GDP that we had in January by the first quarter of 2021, it is quite probable that the level of job creation is going to be weaker than in the previous part of the cycle. Why? Because you've very correctly mentioned, it is going to be extremely unlikely to see companies being able to leverage up their balance sheets further. To start with, because the levels of debt without doing anything are already exploding. We are already seeing that just because of the building working capital and because of the slump in revenues, the net debt to EBITDA of the S&P 500 is going to multiply at least by 2. The second thing that we're going to see is that once the economy gets back on track, it'll be very slow. It'll be very gradual. And many of the consumption decisions of economic agents are going to be significantly affected by the experience of the lockdown. Many of us are not going to go on holidays as much as we used to, or go to restaurants as much as we used to, or consume the way that we did. As such, job creation is going to be different, and certainly, and this is a key point to me, it's not just, even if we are relatively bullish, I believe that 1 month of job losses in the United States can be recovered between 3 to 4 months. However, wage growth, that is going to be the challenge, because at the same time, you're not going to be able to regain the purchasing power of salaries and the purchasing power of citizens in this environment.
Yeah, particularly on the white collar side. We've talked a lot about this. When you're at peak profits and you're levering up your balance sheet to buy back stock and pay yourself these massive bonuses and keep your highest paid employees paid, I mean, that game just ended. And I think people forget that in the U.S. in particular, basically, 77% of the net wealth constitutes 40% of consumer spending. So that's like the few spend many dollars. And those few are feeling certainly less hopeful about their cash flow streams. But on this, in terms of how long it can take to work out, I mean, guys, if you could throw up slide 33, and I want to see if you agree or disagree or where we're at on this, Daniel. So these are our nowcasts for GDP, both on a year-over-year basis, which is, as you know, how we impute the quarter-over-quarter seasonally adjusted number. So that number down 20 or 30, I don't care what it is, really. I mean, it doesn't matter at this point. What matters more to me is on the left side of that chart is how long we have this negative year-over-year economy. So if we have it tracking down 8 year-over-year, like to your point, up 2 to down 8, but then it's like down 5, down 6, like, where am I going to be wrong on that? The economy can improve, of course, 200 basis points from down 7 and be down 5. That to me is the protracted nature of negative cash flows and the lack of, and to me that's the catalyst for not, or the lack of a catalyst for having incremental hiring.
No, absolutely. I think that that chart shows that the economy. The U.S. economy, like most developed economies, was living on borrowed time from the service sector in 2019, 2018. It was the service sector that kept the economy strong while manufacturing was already in contraction. But you saw that lower levels of incremental growth already happening while leverage was going up, and at the same time, monetary policy and fiscal policy were extremely expansionary. Remember that last year, GDP growth was massively helped by a huge increase in the United States of government spending. As such, which is quite surprising for many people that believe that Donald Trump is running massive austerity programs. I don't see them anywhere. But but that is a key factor, because it's going to be it's how difficult it is for the economy to go back to a mirage environment, which is where we were in many cases. Many of us, we did not understand properly how exposed to a cycle the service sector was, in an environment in which commodities, in which the manufacturing sector, we're already telling you quite importantly how challenging the environment could be already before this lockdown.
Yeah.
But now what people find themselves in is in a massive shock that finds most of the US consumers with about $5,000 at best of cash, and most businesses with about 23 to 60 days of cash in the balance sheet. So when we recover activity, almost all over the world, but particularly in developed economies, and more crucially in the United States, those citizens, you can tell them that everything is fine all day, every day, 24 hours a day on TV. They're going to say, you know what?
Tremendous.
You told me exactly the same a few months ago, telling me that this was sort of like the flu, and now I don't have a job, and on top of that, I don't know what I'm going to do with my with the premiums of healthcare and with the schools and everything, because at the same time, this is an important factor as well. As you've mentioned many times, many of the costs of an average family are not coming down. So this is deflationary on one side, but at the same time, the average cost of living is not coming down. So very, very challenging to see the V-shaped recovery. Again, I'm probably, when I look at all the global growth projections, I'm probably more inclined to believe the ability of the US economy to recover, and I'm for sure it'll recover faster. Completely sure it will recover faster and will create jobs faster. But what we cannot expect is miracles, and miracles cannot happen.
Well, I mean, and again, this is why I live here. This is why I raised my family here, built my company here. I do believe actually in the American dream. I live it, even though I'm not obviously an American. I'm a Canadian with a green card, and I'm not part of a political party. For those of you that didn't know that, now you know. But again, like the other part of the miracle. I mean, you've written about this extensively, which is that search. That super late cycle search for yield, and how a lot of companies, and really the US economy, fully loaded with all of its endowments, pension systems, asset managers, got absolutely addicted to that. And isn't it that it would take beyond any miracle God could create? Because you'd have to re-lever the whole thing up on the trailing 12-month cash flows, which have evaporated. So how does that part of the miracle work?
Well, first, it's going to be virtually impossible for it to work. You already know that last year and the year before, a lot of pension schemes were already having problems because of the excess exposure to so-called high yield. I call it no yield. Huh? So what? It's an incredible situation what we see right now, because you have on one side, in a normalized environment today, we would definitely not have negative real yields on sovereign debt in the Eurozone and negative real yields on sovereign debt in the United States. That could help some savers to look for some kind of safety. What you're having right now is the worst combination possible, which is on one side you have financial repression that is keeping artificially low yields on sovereign debt, and on the other side you have a credit crunch. So the challenge is, how do you get an economy that was extremely leveraged to the search for yield prophecy? Right. How do you put it back on that? How do you put it back there? Because right now, somebody who has been trying to find some yield in emerging market local currency denominated bonds is cringing. Is cringing because the little money that you made, actually, even the very little performance over and above the S&P 500, the little money that you made is gone in a month, and now you have massive requirements from all of those economies to refinance maturities, and at the same time, no demand whatsoever, or virtually no demand from investors. So it is going to be impossible for, I would actually say this, it is actually going to be impossible for central banks to convince asset managers and pension funds and small investors to take massive risk for very little yield. The flight to safety is going to be to the extreme. And that makes it, again, coming back to the point of the recovery, impossible to achieve a V-shaped recovery that is based from government's programs on purely massive leverage into the cycles. It's doubling down. If you look at the programs that have been presented all over the world to so-called recover the economy, they're 5 to 6 times in terms of GDP leverage into the cycle, and very little of entitlements and sort of government spending. So that's going to be a very, very difficult challenge for central banks, and that is hugely deflationary to start with.
Well, from a debt deflation perspective and from a pro-cyclical point like it was, guys, if you could throw up slide 96, which is high yield spreads historically. This, by the way, Daniel, like I've had, again, I didn't know how right I was going to be until I saw some of my counterparts on the buy side beg, plead, like quite literally ask for bond high yield spreads to be marked at a certain level. You know, until it happened, I didn't quite know how desperate they were to maintain these schemes, as they're calling them. But again, if you go to where high yield spreads are today, which, and by the way, despite the equity market rallies that you've seen in both Europe and the US, which were just like any other bear market rally, you've not seen a change in the high yield credit risk component of the marketplace. You've not seen it on the Italian sovereign side, Greek sovereign side, et cetera. We can get into those other things. But on the US corporate side, now, why is it not like, and again, the corporate side of the balance sheet was not the problem in 2008, the banks were. Now it's their clients. So again, we go back to 2001 where you see those yields, see how they ripped up pro-cyclically. There was way too much credit as a percentage of GDP, and then they stayed up for 2 years. They didn't go, they came down intermittently, but they stayed up. I mean, they were still 6, 7, 8, 900 over. And that to me, if you can't show me after QE infinity, how that thing isn't coming down like tomorrow, then I'm going to say right back at you that this is not, you can't solve a solvency problem with liquidity. This is time and space. This is gravity. Because the problem is that central banks and governments are addressing the current government planned shutdown as if it was the 2008 crisis. They're putting liquidity on top of liquidity, and they're drowning the economy in liquidity when the problem is solvency, not liquidity. Yeah, there is absolutely no problem. There's absolutely no problem for many of these companies to find credit at the right price. The problem is the price. The problem is embedded in the price. Exactly. Well, I mean, the price is the function of the yield, Chase. I mean, that's it. It's not a function of the demand, in terms of the underlying cash flows of that asset. It's for the demand for the rate of return, which to me, like, that's when I knew, and this is a hard thing to talk about, as you know, like in my business. I mean, I have clients that literally want to rip my hair off, and I like my hair. When this happens, when I talk about this is like quite literally. We had the CIO of one of the largest asset managers on the planet say, "I would like the yield on triple Bs, Cs, whatever, to be marked in a certain range."
Yeah.
I mean, that means that to me means that you and I don't need to be having this conversation. Nobody needs to work on Wall Street anymore. You don't have to do any work. You just need to collect the fees based on the yield that the asset allegedly generates.
Yeah, but every time that I hear that those kinds of things, like demanding further intervention to leave yields at a certain level, whatever, I would say to our dear friends that recommend those things in different financial media, I would say be very careful when you demand socialism, because you get it. And and it's ugly when it happens. So if there is a reason why we have a market, and there is a reason why we all make analysis of the level of risk of an asset. If what you're demanding is that the level of risk of an asset is artificially deflated, what you're also demanding is the counterpart of that, which is that the entire market is going to be obliterated, and that's not what is going to help the economy. By the way, what is going to help the economy is the opposite of what is going to happen. What are we going to see? We're going to see the monster bailout of the past allowing the future to die. This is what governments and central banks are doing right now. They're going to bail out all of the sectors that have massive overcapacity, that already had massive overcapacity in 2019, that already had challenges of technology substitution, that already had challenges of margins, that already had challenges in their balance sheet. In 2009, those will be bailed out, and they're going to let all of the companies that are actually delivering on things that are going to transform the economy to die because they're going to let them drown in a sea of liquidity.
That's crazy. I mean, if that is the commitment, and again, if I love that one-liner because it's true. I mean, if you beg and plead and just execute on socialism, that's exactly what you're going to get. But if that is the commitment, because again, a lot of people may not like what you just said, but that could still very much be what is already happening and continues to happen. That's going to take a long fucking time, man. That's going to take way longer than what the equity market is and high yield market is waiting for. Like, this is the biggest mop-up in the history of mop-ups. This is the biggest crony job that you need, like in the history of crony jobs. This is going to take forever. It won't go away.
That is critical. What you've just said is critical. The other day, when I was saying exactly this to some colleagues, they were saying, that's great, because then what we have to buy is all the junk because it'll be bailed out. And I said, you're crazy. You don't know when. It can take 3 years. It can take 4 years. We can all die as investors, I'm saying, not as people. We can all get obliterated before any of that happens, because governments and central banks don't work with the time that equity investors and debt investors demand. Actually, the opposite. So yes, you might get that, but you might get that once blood is on the street. You don't get that just a month after the market was an all-time highs.
Well, that's the critical point that people completely screw up all the time, is time and space. If you believe that the Fed is all and gravity doesn't exist, i.e. the Fed can bend and smooth gravity, then you better believe that happens in a very short period of time, and then in that short period of time, everything is fixed in a hurry. If it's not fixed, now you're susceptible to, guess what? The same thing, gravity. So that's the problem. I mean, to me, I think that's bananas. On this topic, by the way, you've written books about this. You have a strong opinion on this. I don't know if you heard him say it or not yesterday, but I almost threw up in my coffee when Powell. The last question Powell was asked. And I'm talking about savers, and you've already mentioned negative real yields. Did you see that question?
Unbelievable. Unbelievable. It's a bad time for savers. Yeah, I remember that. Yeah. No, what's happening is the following. If you look at the chart of global money supply relative to economic sentiment and relative to the market, everybody was saying don't fight the Fed, because you see the complete correlation between equity markets and the Fed balance sheet. Obviously, we've all seen that chart numerous times, but that's broken. And what happens now is that this concept of bazooka has turned into nothing, because there's nothing that they can say that is going to make markets go back to the level of euphoria and the level of excess risk taking that they were in 2019, 2018. But it's extremely worrying not extremely worrying. I think that what Mr. Powell said yesterday made a lot of sense, within his mandate. But what he said was very clear for anyone that is actually listening properly and not expecting magic, which is that the Fed is already doing everything it can do within what its ability. Look at where its balance sheet is. It's about 27% of GDP by now, probably, as we speak. But you cannot expect the Fed to bail you out of investments that had the triple negative bet on the dollar, on the economic situation, and on the earnings environment. So if you were basically hugely levered to a weak dollar, and ignoring bad earnings and bad macro, then you cannot expect the Fed to bail you out from bad decisions, let alone bail you out 2 months or at 11% from the peak of the market.
And you didn't really even need him to tell you that, which is on other big things like banks, because banks are long of their clients' problems right now. Oil, because this is a demand problem. Like you said, it's a demand shock. So on oil, I want to make sure we cover that base. What is it about oil that was the leading indicator? Don't forget, it started going down a heck of a lot faster than stocks and high yield credit did. And B, the deflationary signal that is embedded in that could be the leading indicator for months, maybe years. I mean, when I think of where I'm going to be wrong, that's actually where I think I could be wrong, is that this could last years instead of months. I keep getting pushed into shorter and shorter term months because everybody has a panic attack when they don't make money on the long side every day. But anyway, I digress. What is it, oil deflation signal, that is a broader signal for everything else?
Oil is extremely important for so many things that the market tends to ignore. Like, for example, the GDP growth of emerging markets, like the level of reserves of those countries, like the credit worthiness, therefore, of those countries, like the strength of the currency of those countries. So we tend to forget that negative signals in oil demand and negative signals in the oil market are bellwethers for numerous things out there.
Yep.
Weakening trade, weakening growth, challenges, huge challenges for the monetary stability of emerging economies, etc. Emerging economies that are levered to commodities, but not just levered to oil. And this is a critical part. Levered to soya, levered to copper, because it's an indicator of industrial and transport demand. So what has happened is, first, and this is a critical part to remind people of, is that first, the red signals were out there before the coronavirus hit the economy and the lockdown. The signals were already there. Remember that we had attacks on Saudi Arabia's facilities. Oil prices did a little bit of a jump and then came back. We had an Iran-US tension escalation, and oil prices barely did anything. Then you had OPEC talk about another cut, and you had barely any move there. It was already showing that there was, last year, the IEA had to downgrade its estimates of oil demand 3 times in 3 months. So we already had that. And on top of that, that was already telling us that the economy was slowing down. What we've had is the mother of all disasters, which is suddenly you shut down transport, which is 75% of, or virtually 75% of oil demand. You shut down transport, you lock down the economy, and suddenly you have a complete collapse in demand that no supply cut is going to address. And at the same time, a domino effect on storage, which is, what can I tell you? You have about 36 mega vessels outside of the U.S. Gulf Coast waiting with 160,000 barrels, and you have basically the entire Cushing storage filled up. But it's also happening elsewhere. It's already happening in other parts of the economy. It's already happening in Brent as well. And the problem there, again, is the ramifications for so many other parts of the economy. Is what it means for the reserves of emerging markets. Some emerging markets are losing reserves at a rate of about $100 million an hour. So you can imagine that what that does. Obviously, you've seen the collapse relative to the dollar of emerging market currencies dependent on oil. But it's not just that. Is that what does that mean for example, in many of those countries? It means that many governments cannot pay the salaries of civil servants. Many governments cannot. Many industries that are allegedly not exposed to oil are actually very exposed to oil because they don't get their invoices paid, etc., etc. What is happening in Mexico is absolutely amazing in terms of in the combination of negatives. So all of this is what is showing behind the oil collapse. Is that is how weak and how levered the economy was. Remember that in the previous oil price war between Saudi Arabia and other OPEC members, Saudi Arabia massively increased its deficit with the idea of basically leveraging itself for the recovery and then reducing it. But it didn't recover from that level of deficit. And now they're starting into another cycle of debt. We need to pay a lot of attention to OPEC members and oil-producing, commodity-producing nations and their debt because of the ramifications into currencies, ramifications into other industries. Yep. And the recovery and the impact on the recovery.
What a well-rounded answer that was. Like, you talk about asking the right guy the right question. This is, but again, it's taking your approach, which is again multi-factor, multi-duration, across all countries, understanding that global macro is interconnected. I think so many people don't even start with that. I mean, that's hat tip to you for having done all the work to basically answer that question succinctly. My main question though too is, if the Fed isn't buying it, then isn't it susceptible to doing exactly what oil just did? I mean, we don't have people on Wall Street running around begging Powell to step into the oil market, and he hasn't. And that's kind of the point, is that we don't, unless the Fed's buying it in the very short term to mark the prices to model, if you will, as opposed to marking them to market. That's a pretty good example, I think, of where free markets may have traded most things.
Well, that is a great thing. Is that we have in a market that is so intervened and so artificially inflated in so many parts of the economy that the concept of the bubble of everything was actually quite a good one. Is that you have actually some areas that are actually telling you what the real economy is doing, and price is actually reflecting it. Copper was already reflecting it in the last 3 years. We've talked about this, you and I, a few times. The oil price was already reflecting. It was commodities in an environment of extreme exuberance were already telling you that we had to be extremely cautious about global growth and global growth estimates.
Yeah, I mean, it's amazing. I mean, again, I can't remind people enough. When you talk about the market, please don't be silly and think that it's the Dow in points, okay? Daniel's in another country, I'm in a different place. We're talking about global macro. The market is the interest rate market, commodities market, fully loaded, all markets, okay? So again, there's only very few markets, actually, the US equity markets, components of it in particular, that are completely divergent from economic gravity. So again, all of commodities, interest rates, and currencies understand this. But there are parts of equities, all of emerging markets understand this. They've been certified train wrecks. Like you said, certain countries are affected by the demand components and the degradation of the oil price, like Mexico, like Brazil. Those places last week were down 9% on their stock markets. They're down 50% LATAM, EM equities for the year. And then you got places like the place that are you in Spain right now?
Yeah, I'm in Spain today.
Take a. I mean, for anybody who doesn't do the market, I mean, Spain stopped going up. The stock market stopped going up in 2017.
Yeah. Well, well, it's pretty evident. That shows again a very important level of the way how irrational markets can be. No, the Spanish stock market is fundamentally comprised of companies that have extreme exposure and levered exposure to what? To Latin America and to the Eurozone. Okay?
Oh, yeah.
So think
the Fed's not buying those things. Damn it.
So think the exposure that you're having there. The exposure that you're having is negative dollar, is negative, positive cycle, massively positive inflation, and very levered to it. So there was a very, very clear discrepancy when earnings were coming down and earnings estimates were coming down, while at the same time the challenges on those markets were already quite evident. And I think that this is something that is also very typical of the mentality of investment managers in the Eurozone, which is to look at the large companies of the indices and think that they're sort of warriors that are safe from all cycles because they're extremely levered to all of the wrong cycles. Yeah, because an investor in Italy, an investor in France, an investor in Germany, an investor in Spain, a long only institutional investor is likely to think, wow, the top 5 companies in the index of my country are the safest companies. Yet they're also the top 5 companies most levered to the cycles that were going wrong already in 2019, 2018, and 2017.
Well, that to me, I mean, that is the gravity. I mean, I'm not trying to be like Brad Pitt. I mean, it's the gravity. They got him. I mean, that if you want to be long a globally interconnected economy and it's V bottom, you have to include the rest of the global economy. So
absolutely,
that's and that's really what you're talking about. Like, I mean, these economic imbalances. I mean, last couple points on this, and then we'll go to the queue and take some questions. But what is it that you see? Like when I look at, like I mentioned it already, but when I wake up in the morning and I see the divergences between German Bund yields, gilts, and U.S. Treasury yields, for example, versus Italian, Greek, and Spanish yields, what's going on there? How could that possibly happen? I thought that when the Fed prints money, that can't happen.
Yeah, well, the first thing that is happening is that on top of the Fed policy, you have an European Central Bank policy that is way beyond. Every time that I speak with my friends in the United States, and they obviously criticize the Federal Reserve for its lunacy monetary policy, I tell them, would you mind analyzing the ECB? Okay, just for a second, because let me tell you one thing: you're worried about the balance sheet of the Federal Reserve, and rightly so, probably. The balance sheet of the ECB is 42% of the Eurozone GDP. The Fed is 27%. Yet, in the Fed balance sheet, you don't have redenomination risk. You don't have people you don't have, like we have in the Eurozone, people in Italy saying we need to get out of the euro because then we'll be happy and print some lira. You don't have people in France saying, which is about half of the parliament, if I'm not wrong, saying that they need to create a franc that is parallel to the euro and things like this. So redenomination risk with double the balance sheet, almost double the balance sheet relative to GDP. And this is a key factor to me. And no analysis of currency demand, because this is something that I've written extensively about, is that at least the Fed is aware of the global demand for dollars. And that's why it can increase its balance sheet in an environment in which the shortage of dollars globally is rising. But the ECB is not paying attention to the global demand for euros, which has been it's been diminishing in the last 5 years. So the problem that I see in the Eurozone is that it is literally covering in monetary policy such levels of imbalances that when you look at the target figure so the imbalance between Germany and the rest of the Eurozone, when you look at the excess liquidity of the ECB, when you look at the rising deficits of the Eurozone economies, and this sort of perverse incentive scheme by which if you do things correctly, you're penalized, and if you do things wrongly, you get some kind of a support or subsidy, then I get extremely worried.
Should be.
And more important, and sorry to interrupt, because the reason why I get extremely worried is because when I listen to all my mainstream economist friends that say that the ECB is the best thing after sliced bread, the only thing that I come back with is saying, how is it working? How's that working? How's it
working? Maybe they mean it's working because you have negative interest rates and a currency that looks like hell.
But with negative interest rates, with a balance sheet that is 42% of GDP of the Eurozone, and buying almost 20% of all the debt of each of the countries, the economy was already virtually in stagnation in the fourth quarter of 2019 and has been slowing down since 2016. What a fantastic result.
Yeah, what a great economic result. I mean, that's what I'm talking about when I'm talking about the long haul. So when you talk about how long it could take, if the U.S. government is committed to mopping it up like the Europeans have tried, that's going to take one hell of a long time. Last question on this one before I take other people's questions. This blows my mind, actually. A lot of things do these days. But CFTC futures and options contracts, guys, if you can throw that up. Daniel pays attention to this, I'm sure. He used to be, by the way, a hedge fund manager at Citadel. He and I get along for a lot of different reasons, but we used to have the same job, so we speak the same language. Canadians and Spaniards getting along here. But this position is, I just shorted the euro. I always wait to get to the top end of the range, which is 109 against the dollar. But the euro net long position, I can't understand who the hell's buying this. 86,000 net long contracts. That's almost a 3 standard deviation move on a 1-year Z-score, obviously relative to itself. What the hell's going on there? Like, why would people buy euros, never mind just euros, against the dollar?
Exactly. That is the point. You see, monetary policy and central bank policy is not a game of who wins. It's a game of who loses first. This is a key thing that people tend to forget. And currency, the demand for a currency is not dictated by the faith of investors in the government. Is dictated by real demand from people. And if you go anywhere in the world, and you say, hi, can I buy something? I go to Zambia. Hi, how are you? Can I buy something? And you give them some dollars. They will tell you something. You give them some euros, you might actually have a problem with your physical integrity. No, it's this ludicrous analysis that the euro has to strengthen because I say so. When the utilization of the euro has been coming down in the last years, and this is data from the Bank of International Settlements. When the strength of the euro is dictated by the massive trade surplus of the Eurozone, and that trade surplus is going to collapse with this environment that we have. And on top of that, the ECB is increasing money supply at a rate that is faster than nominal GDP and faster than the Federal Reserve is increasing money supply. I don't see how you can be net long the euro, except for the fact that you like Ms. Lagarde more than you like Mr. Powell, but that has nothing to do with fundamentals.
Yeah, it's well, at least see. I mean, on a Thursday, I can feel my sanity coming back here. I appreciate it. All right, to some questions here, and this is a great point. I don't know. I believe in nonlinearity. I wake up in the morning, God willing, 2 feet on the floor, and just to embrace the uncertainty of it all. But when I see, and this question really hits the nail on the head. Daniel, hearing lots of statistics out there that are the largest and the worst ever, and he's going all caps on ever. Do you think the reality of that sets in, or the Fed fixed this?
The Fed might disguise some parts, but it's not going to fix it. It's not going to fix it because The Fed, I think we've already talked about it numerous times everywhere. In reality, the Fed, like the ECB and like the BOJ, have exhausted their capacity to sort of incentivize the market to take more risk quite a few years ago. It was already evident in 2016, and it was extremely evident in 2018. So no, the Fed is not going to fix it. The Fed might disguise it for a little while, and that's why you have to be extremely careful.
Yeah. Okay, so this is going to be a little bit more rapid fire. And by the way, I have a lot of questions on gold right now. I know that that's not your probably. I mean, the way that I get questions these days, Daniel, is on whatever's down that day or whatever's short against me up that day. So we don't want to have those. They're very short term. Gold's obviously down today. That's probably why we have questions on it. But this question, a longer term question from Jennifer. According to the IMF's 2019 Financial Stability Report, which I'm sure, Daniel, you've read, they listed advanced and emerging economies as having 80 to 100% vulnerability on their government debt. What would the impetus to start the cascade of defaults? What would be the impetus to start the cascade of defaults, considering all the central banks are working in synchrony?
It is well. There will be a concerted effort from the IMF and the World Bank to try to avoid a cascade of defaults, because it would be impossible to accept. However, if the weakness of the economy persists the way that we have identified in the last half an hour, and we add to that a massive wall of maturities that emerging economies have in dollar-denominated debt, plus their increasing needs to refinance, plus add more debt in foreign exchange denominated issuances, then I don't see any other option for many economies. And I think that you've already seen it with Argentina, and obviously Argentina is a country that people tend to think obviously that's going to happen there. But I think that the likelihood of at least a very significant domino effect in terms of decisions to default in some form are pretty likely. I think that to me, in today's world, I don't see how emerging markets refinance $2.3 trillion of dollar-denominated debt without either making monster devaluations, which obviously trigger defaults in local currency, or without defaulting on part of that debt.
Yeah, a big part of the dollar bull story is just that. People, again, this is a debt problem on the buy side and in certain countries where they denominated their debt in dollars. So when they become insolvent, they demand dollars, okay? I will ask the gold question just because it's got a lot of votes. And it has to do with, I think that this is an important question to ask. And people are, Daniel, just, I don't know if you get this feedback, but I think people that are long gold are just generally a little nervous because that's something the Fed's not buying. So
yeah.
There's a little bit, it has to actually work on fundamentals. It actually has to work with the gravity, right? It has to work, if you're long dollars and gold, you're actually fighting the Fed. People do have a real, and I think the question really has to do with, like, there was a sell-off in London the last couple of days, and obviously today gold's down here in the U.S., paper gold. But again, are you concerned about people raising a lot of cash and funding? Like we saw, gold had a pretty stiff correction not too long ago when people had to raise cash with the winners.
Yeah. Well, obviously, that's one of the reasons why gold suffers these corrections, is that many people have bought gold unwillingly to find an asset that was decorrelated from equities and bonds, but without having too much of a real desire to own it. Because if your massive long position is please central banks bail me out, then obviously the dollar and gold make you nervous because you're actually betting against it, no? But the case for gold is I would say at three levels, no? The first level is obviously demand and supply. I think it's pretty evident that demand is rising while supply is quite limited. So therefore, it is one of the very few commodities in which you can actually trust in the fundamentals of the challenges to bring further mining into and provide the supply to the increasing demand. The second is that it is central banks themselves who are buying a lot of gold. And as the balance sheet of central banks rises exponentially to address the pandemic, they're also going to buy more gold. But even if they buy just a little, the level at which they have increased their balance sheet is so severe that the amount of gold that they need to buy is absolutely insane. So that is an important. So even if the percentage of gold in your assets is very, very limited, the amount of gold that you need to buy simply to continue to have that percentage of the assets while the balance sheet is exponentially rising is huge.
Yeah.
The third one is what we've been talking about, is working as a decorrelated asset to the cycle. In an environment in which central banks are going to do everything in their power to debase the currency of their nation, then it is not just whatever happens in the United States or in the Eurozone. That is irrelevant. Is that any citizen in Brazil, Mexico, Argentina, Russia, the African countries, etc., when they need to protect their savings and their real salaries, they only have two options, which is the dollar or gold. That's it.
Yeah.
They don't have the opportunity that we might have of looking for some hedges or shorting this or no. These people get their salary. Their salary is literally burning in their pockets as they go home. And the purchasing power of their currency is being dissolved on a daily basis. Look at the chart of emerging market currencies relative to the dollar, not this year, but in the last 10 years.
No, I mean, and this year in particular, while the Fed is going to ramp their balance sheet to $10 trillion. That's why I think it's such a lazy shortcut and really just bad, there's a lot of bad baggage on Wall Street listening to mainstream media, obviously, but it's such a shortcut saying don't fight the Fed. I mean, if you've been fighting the Fed in foreign currency space, you have absolutely crushed it. And that is the point. I mean, last week alone, the Brazilian real was down another 6%. It's down 28% this year. We're not talking about Zimbabwe. We're talking about Brazil. Okay,
exactly.
So that is what it is. Here's a good question, because I don't know what you're going to say to this. I mean, I'm obviously long dollars, treasuries, gold, some healthcare stocks, some consumer staple stocks. So it's not like I'm like anti-stocks, like people like to talk about their stocks. But I will be surprised if you give me a stock pick, by the way. If you're willing to buy and hold anything here, Daniel, on a multi-year time horizon, is there a contrarian play that you've been tempted by?
Yeah, well, a contrarian trade to what we have been saying right now.
Yeah.
Is probably tech. Is probably some tech stocks, because this is the point. As central banks are going to continue to do what they're doing and even further, and rates are going to go lower and lower and lower, I think that some of the stocks that look monstrously expensive from the tech industry are going to continue to be monstrously expensive. That's what I think.
Yeah, well, that's what a macro person should think, because exposures that you need to go to that you currently don't have, hence the answer as a contrarian, get more expensive. Again, that's the whole point of macro. Macro flows towards the asset class or the subsector exposure or factor exposure that is scarce. And there's no valuation limit. I think you and I have learned that a long time ago. But a lot of people go to business school or wherever, they probably listen and hear about this on TV too. Well, I'm going to short the stock because it's expensive. Well, how's that working out for you? I mean, that has never come out of my mouth as the catalyst to short something.
And one thing that we've learned in this crisis is that the stocks that look optically cheap, first, when the market goes down, they fall as much or more than the market. And when the market goes up, they don't go up as much. So one of the things that, and it's extremely difficult as a fundamental analyst, it's extremely difficult, but to try to avoid value traps, in my opinion, is going to be our number one priority in the next 5 years.
Well, and maybe we got 5 minutes left or less here on the clock, but that, as you know, a couple days ago, we saw an epic move. Actually, really this week, when we look at the week-over-week moves in macro, you're going to see an epic move in value versus momentum. And really, when I think about tech, that's the number one thing that scares me. The number one thing that excites me is partly what we're talking about, which is the anti-fragility of certain business models. Naturally, those business models are the creators, the disruptors. I'm building one of those. I get that. I don't want to short my own company because it's overvalued or something. The reality is that, on the other side of that, if you go back to 2000, 2001, what happened was exactly what's been happening, that narrowness of leadership towards tech, the cyclicals and the value kept, what was cheap got cheaper, then all of a sudden, value bounced, momentum came down, and then it all went down together. And that to me, that like when I think about it, I mean, maybe I have my bias because I started in the business back then, but I wondered what you thought about that.
No, it's a great point. Because we can find ourselves in that situation if the entire monstrosity that is being built right now unravels in the wrong direction. My personal opinion is that in any bounce that you see, what we have been accustomed by investment banks fundamentally to be called value, we should get out of, because it's not value to start with. Banks, oil, autos, those are not value stocks. Those are I don't want to say it, but it reminds me. It's Jurassic Park 3, in my opinion.
Well, I mean, look, even if you just look at the scoreboard, people don't talk about year to date this year, Daniel, because all the year to date returns, unless you're long Treasuries gold and dollars, is negative. So we don't want to talk about year to date. But if we talk about year to date, you will see that energy and financial stocks are at the low end of all the indices, and the more levered your index is to the financials, the worse it is. So that's what it is. I mean, you can call it whatever you want. I think that I'd call that flaming pieces of shit that are in people's portfolios. But again, that is genuinely the catalyst that people are nervous about, is that those turn, and they did turn. I mean, regional bank stocks. This Russell, I just got squeezed for a 10% move in 3 days in that sucker because it's lathered up with what? U.S. regional bank stocks. I mean, energy stocks. So that is the thing that does eventually bottom when the recession or depression is bottomed. And I guess that brings us full circle. Doesn't value have to find the end of that before it can actually be well bid for some? Again, the numbers have been cut by enough.
I think so. I think we have quite some way to go. Remember Japan, okay? How many? Well, I don't even know. How many years have we been hearing how insanely cheap Japan is since 1989?
A cheap Japanese bank stock, man. Those things have been cheap a lot of times, huh?
Of course. In 1991, people here are very young that are watching us, I'm sure. But in 1991, when I started in this business, in the financial business, the first thing I read actually was that there was nothing cheaper in the market than the Nikkei. In 1991, I just want you guys to look at the chart since 1991. Okay, so yeah, and the chart is like throwing a ball down a staircase. Is that it does like this, and obviously, there are bounces. But the point that I'm trying to make is that this is the point. The point is we are seeing a fundamental change in the economy that goes well beyond what we have been used to. Which is that it's not just that what we used to call value is less valuable, is that a lot of it has no value. A friend of mine from the oil industry told me when this started, he said, now people are going to understand why a refinery is worth nothing. Mm-hmm. Which was like, So I think that one of the key things that we need to understand is not to. People say don't fight the Fed, and there are reasons to believe that. But I would say don't fight the cycle. Don't fight the reality of what you are seeing in front of you and you want to deny as an investor. You're seeing that inflationary pressures are coming down on everything that we used to generate inflation and move the economy forward. You're seeing how the manufacturing sector is changing dramatically in front of your eyes. You're seeing how the services sector is behaving in a completely different manner. So instead of ignoring it, just embrace it. I think that that's what we need to learn. And I think that we all make mistakes in that process. But what I've learned out of all of this is that what you cannot do is to something that you're seeing every day is to ignore it and believe that we're going to go back to 1989 economy.
That is a fantastic summary of how not only you think, but how you make money in markets. Again, you trade the market that's in front of you, not the one you'd like to have. Ending with it's the cycle, stupid, or don't fight the cycle. I absolutely love that. I wish there were more Daniel Lacalles, but well, fortunately there aren't. I mean, that's that makes this conversation rich. And thanks for spending so much time thinking like as you have. You don't look like you've been doing this since 1991, man. You look great. I am starting to look like I started doing this in 1971, I think. But fully loaded, we're in it. We're both bolted to the chair, and I think people appreciate that. And I certainly appreciated this conversation. So thanks for making the time.
Thank you very much. Thanks for having me. It's been great. It's a great chat, and stay safe, everyone. Thank you.
Thank you. Thank you. He's Daniel Lacalle, one of the classiest and most competent people that actually do macro the right way. Thanks for spending some time with us.